Thank you everyone for joining our financial statements webinar. My name is Lena Castanos and I will be moderating today's webinar. I will begin by introducing the Capital Pathways program. Then I will introduce myself and give the word to our guest speaker, Kara Glashin, business advisor at the Capital Regions SBDC, who will introduce herself and take us through a presentation on understanding financial statements. Feel free to ask any questions through the Q&A function throughout the presentation. We will be responding to them as we go. The questions that we cannot respond to during this webinar, we are happy to address through our one-on-one no-cost services or connect you to resources that can help. We will share a recording and slides of this webinar afterwards. So what is Capital Pathways? It is a program that is funded by the U.S. Treasury SSBCI initiative sponsored by the Virginia Department of Small Business and Supplier Diversity and hosted by the Virginia SBDC and George Mason University. We can start with the program overview, then we will go into program eligibility and finalize with its services. The Capital Pathways program is a no-cost specialized SBDC program that helps small businesses build the systems and habits needed to become capital ready. Why does it matter? Being capital ready matters because those less prepared self-select out of failed applications. Early failures correlate to lack of adequate capital, higher costs, alternatives don't build long-term capacity, only half of requested amounts reach small businesses, and to put things in perspective, about only 25% of small businesses that need access to financing for growth and preserving cash flow get the sorry, 25% of small businesses need access to financing for growth and preserving cash flow. However, just 20 to 30% of those who apply for loans actually get their loans approved. Capital Pathways creates a path to financial and legal readiness. Our program offers an immersive, hands-on group experience paired with one-on-one support. Who is eligible? Very small businesses at any stage facing challenges accessing traditional financing. The services that we provide include a guided self-assessment, legal structure validation, financial skills and tools, and loan application readiness. We start with a self-assessment that pinpoints your business key gaps so we can connect you with the right tailored resources, either through our Capital Pathways program or other resources that can help. Under our legal structure validation, our in-house advisors can help you through more basic legal questions, and we partner with a law firm which can help you for more complex topics related to business registrations, trademarks, and contracts and agreement reviews. We also offer financial webinars on topics including financial basics, financial statement preparation, like today's, and QuickBooks training. Another one of our offerings includes one-on-one individualized and tailored support on business foundations, profitability and pricing, financial forecasting, financing options and readiness, financial statements and tools, and loan readiness and lender prep. Finally, our loan application readiness services include both webinars and one-on-one individualized support. The webinars are on topics such as what lenders look for in loan applications, interactive mock loan interviews, and sample application analyses. We have a partnership with a lender that provides one-on-one support to those looking for capital as well. If you are interested in getting started, you can reach out through our website at virginiasbdc.com/programs/capital-pathways. You can scan this QR code and I will put a link in the chat. And I will send my email around as well so that you have it for your records. I will let Kara share her screen now. And in the meantime, I will just introduce myself. So my name is Lina Castanes. As I mentioned, I am today's moderator. I have a professional background in economic development, small business support, and access to finance projects domestically and internationally. I am currently both the program lead and a business advisor in the Capital Pathways program. So today's presentation is going to be a 90-minute presentation. Again, feel free to ask any questions throughout the presentation via the Q&A function. We will be responding to them as we go. We will also leave some room for questions in the end. The questions that we cannot respond to in this webinar, we are happy to address through our no-cost one-on-one individualized services or connect you to resources that can help. We will be recording, we will be sharing the recording and the slides after this webinar. Now I will give it to Kara to introduce herself, tell us a bit about her background, and start the presentation. Thank you, Kara.
Lena, to confirm, you are looking at my slides in presentation mode?
Yes.
Beautiful. Ready to go. Well, I am excited to be here for this presentation. When Lena asked me to do it on financial statements, I honestly wasn't sure how much excitement there would be from small business owners in the state, but apparently we've got a pretty good turnout. So we are ready to dive into it. Like Lena mentioned, my name is Kara Glass-Sheen, and I'm a business advisor with the Capital Region Virginia SBDC, which is based out of Richmond. I've been doing this for about a year, but before this I worked as a fractional CFO, working primarily with startups and investor readiness. So most of my advising is also financially based, and we're going to jump right into it. So if you are joining this webinar, there's a chance that you may have been, attended some of the past Capital Pathways webinars. There was one I gave last month on just the financial basics, having good habits, separating your finances. There's been some great ones on QuickBooks and more coming up. And so this webinar is ideal for business owners if you currently have some systems that are generating financial data, whether that's QuickBooks or spreadsheets or Xero or one of the many other accounting platforms out there. Ideally, you're also tracking somewhat consistently, staying on top of your financials at least quarterly, ideally month to month. But maybe you're not exactly sure how to interpret the reports or what reports to look at or anything in that area. So today's goal is to help you understand and use financial data with confidence. Now, if you're here and you're thinking, man, I'm not on QuickBooks or I'm not using accounting software, don't worry. This is important information no matter where you are in the process, and you'll get the recording. So hopefully this will help encourage you to take that leap, track your finances with a bit more clarity, and then you'll be able to reference the material we go through today. So throughout the presentation, I will be referencing a particular business. I've put together some sample financial statements that will be shared with you after the presentation. And these are based off of the QuickBooks free test drive, which is available for folks to use if they're learning to use QuickBooks. However, I ended up actually making my own financial statements because I wanted a little bit more detail compared to what they have available. So we will be looking at this topic through the lens of Craig, a Virginia Beach landscape company owner. So hopefully Craig sounds a little bit like you. He is using QuickBooks for invoicing his customers, and he's using it for basic expense tracking. He maybe even has a bookkeeper that sends him monthly financial statements to look at, but Craig doesn't really take much note. He files them away, kind of checks the box, says, great, the bookkeeper's doing their job. But then when he gets into situations, maybe talking to bankers and they're asking questions like, what's your debt to equity ratio? He's in trouble. And at this stage, he's not even sure if his reports are accurate or how to check the accuracy of such reports. But of course, he's busy, but he doesn't actually know, is his business profitable? Are we in a good spot? And while QuickBooks or his accounting software works, it only is so helpful if you're not confident that it's set up right. So our goal is to help Craig and you become more confident users of the financial data you have available. Some learning objectives. Specifically, by the end of this session, I hope that you can understand better what an income statement, also known as a profit and loss, is, what a balance sheet is, and what a cash flow statement is, and what these three primary financial statements show. I hope you can look at these statements to spot trends and even red flags in your reports. And I'll share a couple simple visual tools that'll help us do that. Hopefully, we'll also be able to navigate these numbers in a spreadsheet and then use that financial data to plan, pivot, or seek funding for your business. And finally, we want to be able to apply some quick diagnostic tools to just assess the health of our business, again, based off of these three primary statements. So the structure of today's session is to go through each statement one at a time, starting with our income statement or profit and loss statement, and then bring it all together to talk about how these statements connect and what you can do going forward. So again, the three financial statements. If you use QuickBooks, this may be confusing because you can go to the report section and there's a ton of reports. But today we are really focusing on these three, which are the income statement. This is almost, if we think about these statements like your car dashboard, your income statement is your speedometer. It is how fast are you going, and it's telling you in your business, how much are you earning. Your fuel gauge or your cash flow statement is saying, will I make it, right? Will I make it to my destination? Do I have enough cash? And then your temperature gauge is your balance sheet, which is a moment in time. Is everything healthy? Is your engine working properly? Or for your business, are you financially stable? So just like driving, you need all three to make safe decisions. And to stick on the car motto a little bit, we don't need you to be a mechanic or a financial expert to operate your business. But, just like driving a car, we should know how to look at the dashboard. So that is our goal. Now, as we get into the financial statements themselves, again, I'm going to repeat this multiple times, that they are all connected, that they flow into one another, starting with the income statement. So I'm going to use a laser pointer here. That flows directly into your cash flow statement from your net income. We're going to go into detail, but I'm going to say it again and again, show you, and then we're going to say it again at the end. From your cash flow statement, this tells us our cash balance, which is also info available on your balance sheet. And the income statement is also connected to the balance sheet through your retained earnings. So this is, again, a key concept. If it feels a little fuzzy right now, that's okay. It can take some steps to figure it out. But again, to show that one more time, our income statement or our profit and loss gives us our net profit. Our net profit is brought into the calculation of our retained earnings, which is something we see on the balance sheet. And then our balance sheet is connected again back to that cash flow statement, because our cash flow statement tells us our ending cash in our bank account, which is often the top line in our balance sheet. I'm going to show you these again once we go through each one of these individual statements. Before we go into the income statement, was there a question or do we want to address any quick questions in the chat, Lena?
Nothing has come in so far.
Cool. Oops.
Someone asked to slow down, Kara.
Thank you. I can always use that feedback. So we've got plenty of time here. We've got 90 minutes, a little less now. So with getting started into the income statement, which is your performance report card. The income statement, again, is helping you answer this question: how did my business perform? The income statement is known by several names, so sometimes people will refer to it as your profit and your loss statement. If I'm speaking quickly, I might refer to it as your P&L as shorthand. Just know that all three of these statements are interchangeable. So again, this is showing most often your business performance over a specific period of time. So it could be displayed as an annual summary of your year, could be displayed quarterly. I really like to look at it on a monthly basis because that allows us to see trends over time. But we want to think of this as a movie of your business performance, not just a snapshot. It's not a single point in time. And the basic formula going into your income statement is we've got your revenue, the money you earn. We subtract out all of your expenses, your cost of goods sold, and your operating expenses, and that gets us to our net income. But of course, nothing is ever that simple. So we're going to go into an actual example. And I know looking at this slide is overwhelming, but I wanted to put the whole income statement on one place for us to take a look and to see, and then we're going to break it down into some smaller parts. So typically I do like to start here looking at your income statement by month. We are in September now, so if I was a business owner reviewing my income statement, this is the statement I would want to look at from January to August, displayed on a monthly basis, because I want to see the most recent completed month. And then with the number, the coloring there, I don't want to confuse you with it. The black numbers are sums, and the blue numbers are, hard-coded, typed out. So that's how it works in the spreadsheet you'll have access to. But you can see that when we look at this zoomed in, which we're going to do, to take some of the busyness away, just look at 1 month. We're going to look at May. So again, we can look at our income statement at different time periods, different kind of movie lengths. But the key parts of this, we're going to start with our income section, which is sometimes called our revenue section. It depends on your accounting platform, how this is displayed, the words they use. So it's good to be familiar. Some of these are interchangeable. For this business, for Craig, he's doing what I think is a really good job, and he's breaking out his primary different types of income. So instead of just seeing income or sales lump sum, he's able to pull a little bit more information out and see the income he's generated based on design services, based off of landscaping services, and based on these maintenance contracts. So by looking at all three, separating them, keeping them clean, he might be able to judge how is the profitability different between these, and which one should he focus on more, and change the direction of his business based off of which of his revenue streams are going to be more profitable. Sometimes within the income section, we also see discounts and returns. These are called contra revenue accounts because they'll often be displayed in the income section as negatives. So instead of thinking, if you frequently have your customers returning products, we would, to be able to see and be able to track that over time, it's really helpful to have that separate category of returns. If something's going on in your business and you're getting a ton of returns, that probably is something you should look at as a business owner. Similarly, it's nice to track discounts so you can understand if you're like a retail shop and if you do Black Friday discounts, if you don't have that discount included and we just lump it into all of your sales, it's going to look like maybe November is a bad month, but really you just had a ton of promos available to generate that sales. So a lot that can be shown in that income section. Second is our cost of goods sold. This is known also as COGS. More simply, sometimes people will refer to it for different types of businesses as a cost of sales because sometimes you don't sell goods, right? If you're a contractor, maybe you have subcontract or a consultant and you have subcontractors, then really it's time and labor that goes in your cost of sales. It's not really cost of good. So again, another interchangeable term. But these are the first chunk of your expenses. This is what it costs you to deliver your product or service in a way that can be easily tracked by your business. Now, that it can be for certain types of businesses, this is really easy to understand your cost of goods sold. Like if you sell t-shirts, then your income is t-shirts sold. Your cost of goods sold is whatever you paid for those t-shirts. Super clean. Now, again, different types of businesses, you might not have that per unit item that might go in cost of goods sold. So I see some consulting type businesses who don't have any COGS, and for the stage that they're in, that may be just fine. So if there isn't something clear for you to categorize in this category, move on and maybe talk to an advisor, but you're probably okay. Now, these two together, our income and our cost of goods sold, they are brought together to calculate our gross profit. And so that is your income minus your cost of goods sold. And so here we see that and from there, I also like to calculate a gross profit margin, which is just taken by dividing your gross profit by your total income. So we can see in this case that it's 50%. Now, QuickBooks doesn't spit out a gross profit margin. So if you're wanting to look at this number, the easiest way is to export your statements from QuickBooks into an Excel or a Google Sheet file, and then calculate this manually. But it can be a really useful metric to track over time. Then we're getting into our operating expenses. Typically, these include rent, utilities, marketing, admin costs. Operating expenses here are just displayed on the total. And that will bring us to our net operating income. So our net operating income, we take our gross profit, we subtract out those operating expenses, and we're at that net operating income, which will give us a net margin. It'll tell us what is the profitability of our business operations. Now, for some of you, that may be where your statement ends. It may not even say net operating income. It may say net income. But sometimes you have other income or expenses in QuickBooks or displayed. And I like to mention this because QuickBooks comes preloaded with other expense and other income categories. So a couple examples of this, I'm going to go back to the last slide and zoom in. Some common other income categories, for example, that I see are like credit card rewards. The reason why these are put down at the bottom is because this is not something that you got from operating your business. This is like cherry on top. It's probably not super, that's probably not a large category. But when we're thinking about calculating taxes, we don't want to include that in our taxes. Let me go back. So that brings us finally in this statement to our net income. So we had to take, for this particular business, we had to subtract out that other, we had to add back in that other income to our net operating income to get this number. And this is important, again, because this statement flows into our other statements. And if we pulled this net operating income instead, we'd be off by $43. Again, hopefully we'll get to show how that linkage happens. But let's look at Craig's business again. Now, this is May, so this is a peak season, and what we see here is Craig brought in $16,800 in revenue. He had $8,400 in his cost of goods sold, and his gross profit brought him a 50% margin. Now, all of his operating expenses were $3,825, leading to a 27% profit margin. So my goal is hopefully after this, you can look at your statement and be able to read that out in a similar way. And that would be information you can communicate to a lender or any other person you might be talking about your business finances with. But we want to go a little bit deeper. Like, what does it mean to have these figures? Well, for Craig, this tells him for every dollar of revenue he brings in May, he gets to keep 50 cents after that direct cost. It tells him that his general business operations, which is not directly contributing to him visiting customers, is about $3,825. And so that's what we would say are, if he had no customers in a month, we'd expect that he'd still have to spend about that much just to keep his lights on. He's highly profitable at 27%, and this is excellent for the landscaping industry. So what you can do also as a business owner that I would encourage you to do is look up some industry standards. So if you are in hospitality or restaurants, you can do a quick Google search. You can search by size. There's some good databases out there. Your advisor will be able to give advice here as well. And you can see what is a solid net margin for your industry and know, am I doing really well? Am I ahead of it? Am I lagging behind? And it can give you a little bit more context into what your numbers mean. But again, this is peak season, so this might not be what his business looks like all year. This is just this piece of time. So what he might see when he zooms out is things might look a little bit bumpy, meaning especially when it comes to things like cost of goods sold category. This is you might hear sometimes the accounting terms cash basis versus accrual accounting. And what this means is most small businesses use cash basis accounting. Cash basis is that you record your expenses when you pay them, when the money leaves your account, not when you receive the bill or not when you use them. That's an example of accrual accounting. But as businesses mature, that's the direction most of them move towards. A lot of the small to growing mid-sized businesses I've worked with, they use a kind of hybrid between cash basis and accrual accounting, which can get kind of confusing. But an example of this is maybe you send invoices, and then you look you send invoices to your customers, but your customers might take 30 days to pay you. So if you're looking at your QuickBooks and you see that you can check, do we want to look at this in cash basis or accrual accounting? Your statement might look different. If you look at that in QuickBooks and you change it and nothing changes, then you're good, don't worry about it. But most of you, or almost basically all of you, I am assuming in this webinar, you'll pay your taxes on the cash basis accounting method, meaning you only pay taxes on the revenue that you actually received, not on the revenue you billed in a given tax year. So we want to make sure we understand the difference there. But what this can do is if we just look at stuff in this cash basis sense, especially when we look at cost of goods sold, it can and we look at our gross margin. Our gross margin isn't a beautiful 55% across all months. Instead, we see it's going to be a higher gross margin, a lower gross margin, and that's because of the way Craig is spending on probably these supply costs, these materials and supply costs. So in February, he spent some more money. I think these numbers are a little bit off, so apologies. But in this example, maybe he bought more money, or he bought more supplies in February, which led to, or actually I think, excuse me, in this example, he bought less supplies in February. And so we see these really strong margins, 65% gross margin. We want our margin to be higher. And then in March, he had to buy a bunch of stuff, so we see the margin drop. And then by the third month, we're going kind of to normal purchasing and we're kind of stabilizing. And the reality was that Craig's actual performance was pretty consistent, but the cash basis accounting, the timing of when he purchased the things he needed, when he ran out, was fluctuating. And this can be a lot more extreme for different types of businesses. So it's often good to take that zoom out again and look at a multi-month view of your business. Take the average across multiple months in order to better understand what your profit margins look like. Okay. So some takeaways here is don't panic over a single month fluctuation. Instead, use methods like taking rolling averages, look at quarterly totals, look at annual trends. So maybe compare, what did this look like in the last year? Do we see this smooth out? And what we see is that, the low months, March and April, these are they smooth out to average performance when we take into account February, March, April together. I also want to spend a little bit of time on some of the confusing terminology that I see regarding your profit and loss statement, your income statement. So already we're starting with a statement that has two names that sound different. But it goes further than that. We see sometimes we'll talk about net income. We'll also talk about net profit. These two terms typically mean the exact same thing, and it's just what's left after all expenses. We also see this net operating income term that I talked about a little bit before, but this is really explicitly saying the business profit from core operations. And this is typically what goes on your Schedule C when you file your taxes, if you're filing as a partner, sole proprietor. And it excludes those other sorts of things like credit card rewards, bank interest. Another term you might hear in this same sort of context is EBITDA. EBITDA sounds like a really fancy finance term, and it stands for earnings before interest, taxes, depreciation, and amortization. So it is a mouthful. You see why we want to abbreviate that. And this is a term that a lot of bankers care about. So it shows business operations before financing and equipment. So in this example, if we were to calculate our EBITDA for Craig, we would look at that net operating income, that $4,575, and then we look for that interest and the depreciation, which are included as operating expenses, and we'd want to add those back in to the total to come up with our EBITDA. And the reason for this is, these two, like depreciation, this is not really, this is not a cash expense of your business. That's the over time depreciation of some asset you bought in the past. So you didn't actually spend $800 that month. That's just the monthly amount that is being depreciated from an accounting perspective. And your interest expense, that's the money that you're paying on existing debt to your business. So again, it's not as much a core part of business operations as some other things. And each of these different but slightly similar things have different importance. So our net operating income, again, most common for taxes. EBITDA may become important for loan applications or talking to investors, talking about profitability. And net income is for overall profitability of all operations. And again, net income is the one, also known as net profit, that'll flow, into our cash flow statement. So we'll see that again later. Now, a quick aside here, because some of your businesses might be sole proprietorships, might be taxed as a sole proprietorship or a partnership. So you'd typically be an LLC, but your LLC is going to have these different tax classifications. And for those of you with LLCs, taxed as a sole proprietorship or a partner, business profit will show basically your personal income. Your net operating income is pretty close. There could be some adjustments for different deductions, but pretty close to what you pay taxes on. And your owner's draws, which is how you take your pay if you're in these two tax classifications, don't affect your tax because you're taxed on your profit regardless of if you put that money in your personal account or you leave it in your business account. This is different for S Corp elections. So it's not a business, that business entity isn't S Corp. You're an LLC taxed as an S Corp. There's reasons to do this for a lot of small businesses. Once you get to a certain stage of profitability, there's some tax benefits to it, but this makes you an employee of your own business. So you have to take a reasonable salary shown as an expense, and then the remaining profit is what is passed through to your personal returns. The benefit, again, your salary reduces the business net income. And for our example here, what we're looking at, Craig is taxed as a sole proprietor. So if we look at what we see, he's not taking a salary on our profit and loss statement. He's taking, his business is generating net income, which is what he pays taxes on. And that in May, which it was $4,618, but he takes owner's draws monthly of $3,000. So he's not paying taxes on the $3,000 for the month of May. He's paying it on the $4,618. If Craig were to elect to be an S Corp, he would have to pay himself a salary. And then on top of that salary, any profit he could take on top of. So, this is a lot. We are almost, I think we can maybe pause there for some questions around profit and loss, if there's any.
Yes, I didn't want to interrupt, but there are three questions.
Let's
Maybe
go.
we can get through those first, and then after each financial statement, we'll have
Mhm.
room for more questions too. So the first one would be, how do you categorize the promo discount under income as negative?
So if you're dealing in QuickBooks, and it depends on how we see this, there's a few techniques to it. So maybe you see a transaction exiting. So of you, let's make a simple example. You sold something for $100 and you gave a 10% discount. So the cash you see coming into your bank account is 90. So there's a few ways to deal with that. In QuickBooks, you could split the transaction. So we could say 100 goes to revenue, negative 10 goes to discount, that promo discount category. So you have to have those two categories made in QuickBooks. Another technique I've seen accountants use, I've used myself, is you can do journal entries to adjust the amount that you're seeing come through QuickBooks. So at the end of the month, you see that total, so it would say 9,000, say you sold 10. Then you can talk to an accountant to come up with a journal entry to then split that total amount into what was truly sales and what was promo discount. Now, this is a more advanced, heavy-handed way to do accounting. So for a lot of folks who use something like a Stripe or a Shopify, they might want to actually look at this outside of QuickBooks and not get into the weeds on making sure the accounting is aligning, because a lot of your sales platforms, your POS systems, will be able to show that for you as well. So this is why it's useful to, again, export your statements and dig in a little bit deeper using Sheets or Excel if you really want to understand your numbers. So.
Thank you, Kara. The next question is, can you give us examples of the operating expenses in this example? Electric bill, etc.
So here we've got the statement pulled up showing those operating expenses. So we can see automobile, fuel, equipment rental. So these are things that for Craig, he was unable to tie specifically to a job, a specific job. And for different businesses, that's going to be the case. You're just not going to be able to say, hey, this much was used on this customer, this much was used on that customer. So it's just part of our operations of the business. Maybe sometimes the equipment was used for training or just, more generically. And it's, it's up to you how you categorize things. You as the business owner are the most important person in terms of understanding your categories. So if your accountant gets it, but you don't get it, like what these categories mean, talk to your accountant and figure out a way to update those categories so that they work for you. But we can see insurance. Most businesses need some form of insurance, at least general liability. Some industries, you need a lot more. Professional fees. This is typically your accountants, your bookkeepers. Equipment repairs, so wear and tear on stuff you have, depending on your industry. It could be a regular reoccurring expense. We see sort of your office expenses. Office, if you have an office, maybe phone bills. Now, it's a whole separate topic that I don't want to get into today, that if you have a home office and you want to think about home office deductions, things like that, there's kind of different ways to handle those personal mixed use type things. So we want to keep it simple for today, but you can always talk to an advisor and go in greater depth there. But most often we think of like selling, general, administrative are your costs that go in your operating expenses. So definitely we expect to see marketing, advertising, even if that's just a website hosting or printing flyers. Not every business needs a sophisticated marketing budget. Bank fees, and then the interest and depreciation or two that we talked about. Again, this is going to be really different by industry. It's customizable. It's customizable by you, by your accountant. We want to keep it simple and we want to keep it clear. a mistake that I see people make, and technically it's not a mistake, but I'll see people do it and it's just really messy to look at, is you might have like, I've seen people list out every software they use. So it's like Canva, Adobe, Microsoft. That's going to make your income statement look huge and crazy. And it's going to be really hard to look at the monthly view and look at trends over time, right? We want to be able to see how are these utilities changing month over month. If you have too many categories, you don't have the summary to get those trends. All right,
Thank you,
next.
Kara. Sorry, I may have missed it, but may you please provide the formula at the end to get the gross margin and net margin? Thanks.
Sure, absolutely. And I will say in the Google Sheet that we'll share at the end, all of these black numbers are formulas. So if we go into the sheet, you can double click into any of those cells and you'll get those formulas. So your gross profit, again, I'll just say, is net income minus cost of goods sold. That gross margin is taking that gross profit and dividing it by your net income. So apologies, should have written those out for you, but happy to share them in a follow-up. However makes sense. All right, so we're gonna charge ahead. Now that we've talked about your income statement, your profit and loss, we're going to talk about how we can use it to make decisions for your business. And first way is by using something called the simple expense control rule. So in order to use this rule, you need to be watching your financial statements, specifically your profit and loss, your income statement, month over month. And specifically what you're looking for here is not just your sales number, but your gross profit number, which again is your revenue minus your cost of goods sold. And you want to be watching for how that gross profit number is changing month over month. So in an example here, Craig's profit over, I think I don't remember the months, but it was across 3 months. Craig's profit drops from $8,400 to $7,200. This is a $1,200 decrease in profit. So what the expense control rule would tell him, all right, I saw this much of a drop in my gross profit. That means I need to get busy trying to cut operating expenses by the same amount. The reason for this is if we see our gross profit go down, if we simultaneously pull down our operating expenses, then we'll see no impact on our net income or our profit level. And this can take a minute to kind of get through, but graphically, the reason for this is that most businesses, really what you care about is cash, is profitability, not necessarily top line revenue. And when we see in this example here, at this earlier stage, I'm going to use my laser pointer, at this earlier stage of business, where here we see some lower sales, lower gross profit, but our operating expenses are all the way down here. So all of this blue triangle, this represents the cash you get to take home, your income. Now, if we look at this later stage of the business, our sales, our gross profit has gone way up. So from a lot of people, we'd be like, this is amazing, this is great, our business is doing really well. But look at what happened to our operating expenses over time. They have also gone up and they've grown faster. So at this point in time, our revenue is higher, our gross profit is higher, but we have a much smaller triangle of stuff that we take home. So using this simple expense control rule, if you look at your statements you need at least 2 periods of time, and you see my profit, my gross profit has dropped from 8,000 from one amount to another amount, which let's see is, so I think like from right here to right here, we see a drop in our gross profit. What we would want to do is think, okay, how can I look at my expenses? What can I cut to make up for that drop in profit so that that in gross profit, so that my net profit, my net income at the bottom remains stable? Because instead we're seeing his net income drop month over month. That may be hard to do. That is a goal, but it is for really savvy business owners that have a really tight hold of their financials, you're thinking about making cuts. What can I get rid of? What money am I spending that is not contributing directly to business growth, higher sales? Ooh, excuse me. Now, this next piece is that we can look at our income statement for trends. So this can look really confusing. I recommend you take this presentation after and really study these different categories. Basically what this is we're looking at sales, which is that top line revenue. We're looking at gross profit, which is sales minus cost of goods sold. We're looking at operating expenses, which is, that whole category of stuff there. And we can do a really quick analysis to be like, what's going up, what's going down, and what does that mean? At first look, you might think all green arrows, that's good, right? We like green arrows, we like increases, but this is not the best position to be in because in this condition, we're seeing gross profit going up. We're also seeing operating expenses going up. So the explanation here is, while it's a good position to be in, you need to be watching those operating expenses. So what you can do with this is you can look at your income statement, look at the trends, and see what's going on, what direction are my arrows pointing, and what does that mean for my business? So if we take Craig as an example, these are Craig's trends going from June to August. His sales go down. His sales are decreased from $2,500 or by $2,500 between June and August. His gross profit is decreased by 650, so not as extreme, right? The sales went down more, but his gross profit wasn't as bad because he wasn't using as much cost of goods sold, so it hurt him less. It's a little blunted. But then we also see operating expenses went down. So this could be good, but if his operating expenses went down a lot, it could be all right. But his operating expenses only went down by 140, which meant that if he used that expense control rule, his operating expenses fell by that full 650, his profit would have remained steady. But his profit dropped by 510. So the explanation here is things aren't looking as good here, but this company may need to cut expenses to be able to maintain or increase profit. This company may need top line action, aka more sales. For Craig, though, that may be hard to do because maybe August was a bad month for landscaping. I wouldn't think so, based in Virginia, but again, we want to take into account your specific business. And I'm not going to get into each of these explanations because I want to be sensitive to time. And this is the biggest section, by the way, the income statement. The other sections are a little bit smaller. Now, we can pause again if there's any new questions related specifically to the income statement, the P&L structure, interpreting specific numbers, these cash basis accounting, and where to find industry benchmarks, and any terminology confusion. Anything there?
Yes, there is one more question. If our LLC has two members and not a sole proprietorship, should we still be paying ourselves regularly and counting it as an expense?
So this is where I recommend talking to a tax accountant, but the default tax structure, if you are an LLC with multiple members, is partnership. So you're taxed as a partnership. At the end of the year, you should be receiving a form called a K-1, which is your individual partner earnings. And then those K-1s are going to be passed on to your personal return, which means that you are taxed on the profits of the business, and your pay typically isn't run as a salary running through payroll, meaning we're not using a service like ADP to cut a paycheck, to deduct taxes, to do all that. Now, if you are using a payroll platform and you are withholding taxes and you're paying payroll fees, then it sounds like you either are or you should be electing to file your taxes as an S corporation. So if you're already in that structure, again, there's some really solid tax benefits to filing your taxes as an S corporation, but only if your business has the cash flow to allow it, meaning you have to be steadily profitable over time. And you have to be able to have the structure internally to handle, doing bi-monthly payroll runs, the administrative time and cost that goes along with it. So I'm not sure about your particular situation here, But most likely, again, LLCs, the default tax structure is a partnership. Therefore, you are taxed based off of whatever your operating agreement says you should be. So most partnerships are 50-50 ownerships, and you should be splitting profits of the business 50-50.
Mhm. Thank you. Someone complimented and said that, wow, Kara, very impressive training. Thank you. Um, thank you for that feedback. I agree. Um, the next person said, where do you find industry benchmarks?
So my favorite place to go is I use with SBDC, we have a subscription to IBIS World. So we get huge industry reports. We can get industry benchmarks from that. That is a paid subscription. So you'd have to ask your SBDC, or your advisor that you're working with, your Capital Pathways advisor, to get those reports for you. But that said, for most industries, a quick Google will work. There are free websites out there. What I would warn you is that the benchmarks are going to be different for different size businesses. So if you're making less than $1 million in revenue, it's probably a different benchmark than if you're making 10 million plus. So I'd say pull a couple sources, try to find it that most closely matches your business, and then, otherwise ask for someone with a paid subscription to a fancy service. All right. Is that the last one?
Yes, you can. No more
Good to go.
questions.
All right. We are on to financial statement number 2, which is the balance sheet. Now, the balance sheet is your business's financial snapshot. It is a point in time, one day. So when you look at a balance sheet, most of the time it says your balance sheet as of, you could pull it, September 17th, 2025. I don't find it as useful to look in the middle of the month because I like to see end of month financials, because probably your accountant or you has gone through some extra effort to close your books. But again, point in time, one day, where is your business? What is your business's health on that day? Your balance sheet answers the question, what do I own and what do I owe? It shows, again, that one, I'm going to say it a billion times, like a photograph. Your P&L was a movie. This is a still. The basic equation you might hear is that relates to the balance sheet is that your assets, your business assets, which is the stuff you own, is equal to your liabilities and your equity. Your liabilities are the money that you owe, and equity is what you've built over time. So again, your assets, that is cash. That is equipment. That is stuff that you could feasibly sell for money if you wanted to. Your liabilities, money you owe. So whether that's to vendors or to lenders, that is money that maybe you have in your bank account that eventually is going to have to leave for one reason or another. And equity is kind of like the forensic history of your business. It takes into account everything you have ever paid yourself over time, anything you have ever invested into your business over time, and what your historical, again, I mentioned that your retained earnings include prior months' net profit that gets rolled into that equity section. So that's what you've built. If you have a business that's profitable year over year after year, then your equity section is going to go up. If you have a business that has lost money year over year over year, your equity section is going to go down. So that's the start of it. Here is our example. So this is for Craig's business. First, we have our assets. The assets represent the whole left side of the screen. So most of the time at the very tippy top, what we see in our assets section is our bank accounts. So you can see Craig, he has 2 bank accounts, his checking account and a savings account. If this was a real business, I would want to see, bank A, checking, parentheses, 4431, the last 4 numbers, to keep it straight, to make it really clear which account is this, just to keep it tidy for yourself. But this is a generic example. We see accounts receivable. This means that Craig is he's sending invoices through QuickBooks, which means this is telling us that there are $18,000 of invoices that he has sent to customers that he is owed. So that's why it's an asset. It's while he technically doesn't have that cash sitting in his account, it's due to him. This shows us that Craig is also putting some inventory on his balance sheet. He's tracking inventory. This might not be something that you do as a business owner. These are sort of mid-level advanced accounting techniques. So you are likely, if you're an earlier stage business, to not have these sorts of accounts on your balance sheet just yet. It is, again, if you look at your balance sheet and you have these accounts and you're like, I don't know what this means, you might be using them improperly, or you might not just understand where they are. So I recommend talking to a financial advisor, an accountant about it. This prepaid insurance is on the balance sheet because it's, for some reason, he decided to put a big payment into insurance early on and he didn't want to expense it on his income statement for operating reasons, or his accountant made this decision. Again, these are advanced accounting decisions to make. But more commonly, we see some fixed assets. So for Craig's business, he owns a truck. This is the original purchase price, $45,000, but he's owned that truck for at least a few years. Trucks have a useful life, 5 to 7 years, and he has accumulated $18,400 in depreciation. So net trucks is what he paid minus the accumulated depreciation. The value on his balance sheet, the asset value, is $26,600. Similar with equipment, and that sums up our current assets and our fixed assets to that 73,000 number. Now, if I have these two numbers circled, because you can see they balance, they are equal. Our assets are equal to our liabilities and our equity. So here is our liabilities section. What we see are accounts payable. This is money he owes to vendors. Again, this means that he's receiving invoices in QuickBooks and he is marking that he's received those invoices. And so when the money goes out, it's important for him to match the payments he makes to those outstanding invoices. So again, more advanced accounting. If you are not tracking bills received in your QuickBooks, you should not have this account. If you have this account and you're not tracking bills received, there's probably an error. Then we have credit cards. This is the balance on his credit cards. This means he owes Discover, Visa, whoever, $2,400. And then sometimes we see a split between loans for the current portion and like the long-term portion. Most often the current portion is what he expects to owe today. Again, this is more advanced accounting to split out the current from the long-term. Maybe it's like a 5-year loan. I don't know. I prefer, for most clients that I work with, just keep it simple and put it all, if you have a loan, just put it in long-term liabilities, maybe not split out the current portion, but that is my preference for simplicity, not for beauty and accuracy. And anyway, these sum up together to our total liabilities. So we have our assets, liabilities, and then we have our equity, the history. What this is telling us is that Craig, at one point over the course of his business, has put in $15,000. He has invested $15,000 into his business. Retained earnings, so the sum of prior years' revenue is $21,000, and his year-to-date net income is $28,000, which is great to see. If he's been in business 2 years, it's a good sign that things have been improving. And the owner draws that he's taken over the history of his business are equal to $23,000. We see this as a negative number because it's subtracted out. He took this out of the company. He removed it from the company versus putting money in. So his equity is at $40,000, bringing these two equal. So that is a quick dive into this one. Now on this slide, I went into that again in the same detail. I highlighted some of these accounts because these are optional, more advanced accounting styles. But I think we covered most of this in those assets, liabilities, and equity. So another note on terminology here. For Craig, he is taxed as a sole proprietorship. He's an LLC taxed as a sole proprietorship. So we see the terms owner investment, retained earnings, owner draws. If he was taxed as an S corporation, then we would see slightly different terms that mean kind of the same things. We'd see paid in capital. So that means like an S corporation has shareholders. So the paid in capital is the same as that owner investment. Retained earnings would remain the same. And then distributions to shareholders or owner distributions is an equivalent term for owner draws. So again, just a note on terminology that sometimes we like to make things complicated. And they mean essentially the same things. Now, we're going to get into, if I ever have a new client and I'm looking at their QuickBooks or I'm looking at their accounting, someone who's applying for a loan, one of the first things I do is I look at their balance sheet and I look for a couple of red flags. I might ask them to confirm that the cash we see on your balance sheet as of a certain day should match your bank account, your bank statement. So if I pull a bank statement for August 31, I should be able to look at the balance sheet and go, those should be almost always exactly equal. Maybe they could be a little bit off due to timing. That can happen if there was a payment like right at the very end or the very beginning of a month, but they should match. And as a business owner, you should understand what each account describes. If you see an account and you're like, I have no idea what that is, or it says taxes owed, but I'm a single owner, solopreneur, paying myself through owner's draws. Why do I have just any sort of questions like that? And then on your balance sheet, it's really important to make sure that you understand any negative numbers that you see, because some accounts just don't make sense to be a negative number. So for example, if we looked at your credit card section and I see negative $2,000, what would that mean? And I know we don't have a chat session, but I want you to take a second to think, what would that mean, a negative $2,000 credit card liability section? I'll go into it. It would mean that the credit card company owes you money, which would be great, but is unlikely that a credit card company owes money. So here we have another balance sheet, but there are 8 errors on this balance sheet that I've counted. So I want people to take a second to skim through this, pretend like this is your statement, and try to find at least 2 things that look suspicious that you would want to ask your accountant about. Give you 10 more seconds. Answers. Something that I see a lot of is our bank accounts. All of a sudden, we have multiples of maybe the same name and maybe one of them has a 1 by it. That would tell me, ooh, maybe at one point an account was accidentally disconnected and then re-added. And then we see the old original account with a weird balance, like negative 100 on your bank balance. You probably don't owe your bank money. If you do, maybe a little negative dip, but that should be temporary, right? We also see a negative accounts receivable. Again, if this was accounts receivable is money that customers owe you, that you're waiting to collect. A negative accounts receivable means you over collected from your customers. You owe money back to your customers. That shouldn't happen, shouldn't be on your balance sheet. And what it's going to do is it's going to pull down your assets. So we see negative current assets for this business, which should be a huge red flag. I didn't circle that one because it's a summing issue, not the root cause. Here, this one, net trucks, negative 5,000, because you have accumulated more depreciation for your truck than you ever paid for it. And you now have a negative asset on your balance sheet. Again, shouldn't happen. A negative asset means you owe money. You don't owe anybody money on this truck. Probably you made a mistake and depreciated more than you should have. We see same sort of thing on loans. It says negative 26,000. That would tell me that you overpaid your loan by $26,000. The reason I see negatives in this category most often is because people took their entire loan payment, including interest, and applied it to the balance sheet, when really the interest payment is separate. Say you had a loan that collected 10% interest, and you put all of those payments towards the principal on your balance sheet. Over enough time, that's going to be negative. So we need to check on this and adjust it to the actual remaining loan balance, put the rest as interest on your income statement. Finally, our equity section, owner investment, should be a positive number. This is money you gave to the business, and owner's draws should be negative numbers. So we got those signs switched. And then the biggest problem is that our assets do not equal our liabilities and our equity. So hope that was fun. Now, another health check you can do using the balance sheet. This requires that your balance sheet is, roughly accurate. Something that bankers may ask about is, what is your debt to equity ratio? So this is a formula where you take your total liabilities and you divide it by your total equity. And for Craig, he has 33,300 on his balance sheet section in liabilities. We're dividing that by the total equity, 39,793, and we're getting this number, 0.84. Now here's a little key for what that means. Anything under 1 means that you own more than you owe. This is good, right? You don't have too much debt on your business. Anything from 1 to 2.5 means it's acceptable range for most small businesses. Anything over 2.5, you may struggle to get loans if you start to have a lot more debt than your business has in equity. And anything over 4, this is like fire alarm, red alert, your business is struggling, and this is a big financial stress warning. Or it's possible that you might have over 4 if you are able to get a startup loan to start your business. You're going to start in the hole, right? You don't have a history, you don't have long-term earnings, you have a lot of debt. So we need to make sure that over time, the direction you're going is going to decrease that debt and increase that equity over some fixed period. And so bankers care. And so this ratio can show that you believe in your business enough to invest your own money. So that's one way to increase that ratio. Of course, the best way is to have solid, repeatable years of profitability. That can be hard if you're a new business. And just another note that this is not that typically bankers will look at your balance sheet over at least 12 months to get an idea of how this ratio has changed over time. Because if you had, you could try to cheat the system by transferring all of your savings into your business bank account. And that would artificially increase your business equity. But if you're planning to take that cash out, then it won't help. And if you're applying for a loan and you have money in your savings, maybe you don't need the loan after all. So that is the debt to equity ratio. Now, I told you this section would be faster. So that wraps up our balance sheet. Do we have any specific questions to the balance sheet?
Yes, we have 2. Are these accounts checking and saving his business accounts?
Yes, absolutely. So your personal accounts should not be visible on your balance sheet. These are certainly business accounts. If you made a mistake and you linked your personal account, that will create a lot of mess. It will stress out your bookkeeper, and I'm stressed out thinking about it. So,
Uh, Second question is, as an LLC, I pay myself as an employee of the company through payroll. Should I continue paying myself as an employee, or should I just do owner draws instead of paying those payroll fees?
that is an individual question, and I want to say for S corp elections for any given tax year. So, for example, 2025, you had until March 31st to elect to file as an S corp. So it is too late right now in September to elect to file your taxes for 2025 as an S corp. So I would. I don't want to give direct advice without knowing exactly what's going on, but I would, chase that question down and try to figure out, is there any advantage to what you're doing? Because if you haven't made that election, then the advantage is, it's confusing. It's not ideal. It's a little messy.
And we can look more into your situation through our one-on-one advising.
Absolutely. Okay. That was it.
That's it.
Beautiful. All right, last one, guys. And we've got 20 minutes. We can do it. The cash flow statement. So this is my favorite statement. It is the most overlooked statement, but it can I have a lot of business owners who come to me and they say, like, my business seems to be doing well. Profit income statement looks good, but like, where's my money? Like, I'm I'm not able to pay myself. What's happening? The cash flow statement is where we can answer that question. So where did my money actually go? So now this statement, unlike the balance sheet, is again looking at a specific time period. It's a moving picture, it's a sum. It shows actual cash moving in and out of accounts over specific time periods. This statement explains why your business can be profitable, but your business might still be broke. This statement is separated into 3 categories. There are operating activities, which are day-to-day business operations. This is where we take that net income from your income statement. We start there with our operating activities, and then we basically adjust that number for the net impact on cash. Then we have investing activities, which is equipment purchases and investments that you're making. So investing activities is investments that your business is making into long-term things, buying big stuff mostly. And then financing activities, these are loans, loan payments, owner draws, distributions. So these are our 3 categories. We're going to look at this. But the critical point here again is that business revenue, net profit is not the same thing as cash received. Quick note is that there are actually 2 types of cash flow statements. One uses the indirect method. This is what we're going to be going into today. The reason we're using the indirect method is because it's more common on most accounting platforms. There's also the direct method, and a lot of people prefer the direct method because it shows it's like more using more common sense to the direct method. But since QuickBooks uses the indirect, we're going to go that way. And so basically the indirect method starts with the net income and then adjusts for non-cash and working capital changes, versus the direct method would show all the sums of the different cash ins and outs in the operating. It would get us to the same number, but it's just displayed differently. Now, so again, our indirect method, our cash flow statement from Craig, we're looking at a specific month here. We can see in August, again, we start with his operating activities. That is this first section. We most often see this summed up, net cash from operations. This starts with that net income number. So if you flipped back to his income statement, this would be the August net income. Then we have to adjust for what actually happened with his cash. So the depreciation, because he's depreciating an asset he bought a ways back, he didn't actually spend that $800. So understand the cash effect by operations, we get to add back in that $800 that was subtracted on his income statement. His accounts receivables is showing negative $2,800, which is a negative cash impact. This is really confusing, so I apologize in advance. It has a negative cash impact, but negative numbers on our AR is actually showing an increase in that account. So this means that he sent more bills to customers than customers paid him. So he counted more stuff on his income statement for revenue where he doesn't actually get to put the money in his pocket. So when we think about the net cash from operations, we have to subtract out those unpaid customer invoices. Inventory, again, a negative number represents an increase in our inventory account, meaning he bought $600 more worth of stuff during that month that maybe he didn't use. So the balance sheet went up, but it's a negative impact on cash. AP, similarly, accounts payable. This is actually the opposite, because accounts payable is money you owe to vendors, and an increase is positive, meaning he has bills from vendors that he has not yet paid, so he needs to pay the vendors, but he hasn't yet. That $1,200 is still in his account, so at least for this month, cash-wise, we get to add it back in. Now, I know this is confusing. It has taken me a long time to get these concepts straight, the signs. If you are not using these, just keep in mind, it could come up in the future. If you are using these accounts, it's taking a little bit of time to try to work through it in your real business. For investing activities, he didn't purchase any equipment, so 0, easy. Financing activities, he did make some loan payments and he did pay himself. So we have to subtract that $3,600 from the financing section. And overall, even though he was profitable, 3,700, even though he only paid himself 3,000, the net change in cash for that month is negative $1,310. His starting cash was $7,930, and the cash at the end of the month, was $6,593. Now I have this highlighted green because if I were to flip back to our balance sheet, that is the same number we see on total bank accounts, 6,593. 6,593. So again, these statements are connected. Now, why profit doesn't equal cash? Well, you could say, hey, I made a $3,740 profit that month, but your cash decreased. So why did this happen? Again, it's because of changes in these accounts. He has sales that he made that the cash wasn't collected. He paid himself $3,000 and he had to pay off an existing loan. Note that $280 that is on the P&L. So that the loan payment was split across our P&L, our income statement, and our balance sheet, which we see on our statement of cash flows. So our lesson here, again, you can be profitable and still have cash flow challenges, especially when the numbers get tight, especially on off seasons, especially if you have a bad month. So it's important to still pay attention to more than just your income statement. Now, I know this is getting tiny. I'll try to zoom in. Some cash flow red flags and some trends to watch. What do we want to worry about? In our operating activities, we need to look and see, are our accounts receivable, if we're using accounts receivable, growing month after month? That means that customers are taking longer to pay. That means you have outstanding bills to collect. This is a common issue I see in small businesses that send invoices to customers. You're so busy selling and doing the job, even your best intentioned customers, they might forget to pay you and you're not chasing them down. That hurts your cash flow. You can get yourself in trouble. A lot of business problems can be solved just by better collections and paying more attention to accounts receivable. You might have negative operating cash flow repeatedly, which means that you are spending more than you are earning. So we want to watch that net cash flow from operations. So far, this is good. And then we might have working capital consistently draining, so inventory and AR growing faster. So we want to watch all those accounts. And let's look at, and some potential patterns, red flags would be that your cash reserves are dropping month after month. Now, this is one I think Craig has. If we start in January, his cash reserves are dropping. He had $19,000. Business looked good. He was steadily profitable. But by the end of the time period in August, he's had a net loss change in cash of almost $16,000. So if he continues on this exact same trajectory, he will run out of cash. So things need to be corrected. He needs to sell more, he needs to drop operating costs, he needs to do something. And so why did this happen? Well, he spent $11,000 on equipment. Maybe he had to do it. Maybe there wasn't a better way, but even with that heavy investment, I would expect to see a higher increase in income and revenue. We're not seeing that. Similarly, we're seeing owner's draws it's good to see consistent owner's draws like this, but that's ticking away at our cash. And he's taking bigger owner's draws here, June to August, than he was in January. Why did he make that decision to increase his owner draws if his business cannot support it? So some things there. Now here's another tool that I recommend you can revisit later. I'm not going to go through this in detail because of time. I'm going to look at a smaller subsample of some of these patterns. Looking at pattern 2. First is if we see, so we're looking at, again, the operating activities, the investing activities, financing activities. So we've got Craig's statement on the right. First pattern is healthy growth. This is where we see net cash increase from operations, where we see negative investing activities, which means he's purchasing buying equipment, and negative financing, which means paying down debt. So that's a good thing, right? Business is growing, you're investing in your business, you're buying stuff, and you're also paying down your debt. If we see another pattern would be negative, positive, positive. This is where you have negative operating, positive investing, positive financing. You are losing money, you are selling assets, and you are borrowing to survive. This should make most people nervous. And there's something going on in operations that needs to be fixed immediately. Then there's pattern 1, which is building reserves. Everything is positive. You are making money, you are selling assets, and you're getting loans. It sounds good, everything's positive, but maybe it's time to invest in growth. Maybe you should be buying some equipment. Maybe you should be thinking about expansion. So again, this is another tool that you can use once you are confident looking at your statement of cash flow to say, what is the pattern across operating, investing, and financing activities? And what does this mean for my business? So I encourage you to spend some time playing with that. For Craig, we see he is in the positive, negative, negative category. So we can flip back. What does that mean? It means the company is using cash flow generated from operations to buy fixed assets and pay down debt or pay down owners. So generally a pretty good place to be, not a danger zone, but because we're also looking at trends and we're seeing that cash drop, we need to be worried about what's going to happen in the future. So good statement analysis requires looking at your statements from multiple angles, looking at patterns, looking at trends, and understanding, most importantly, what each line, what each category is talking about. Even if it's a little fuzzy, you should at least know what it relates to as part of your business. So any specific cash flow statement questions?
We don't have any right now.
Beautiful, because
Mhm.
I've still got a little bit more to go. How these 3 statements connect?
And sorry,
Yeah.
Kara, if we go over a few minutes,
Mhm.
that's totally fine
Cool.
too.
I
Mhm.
think we should be right on the money unless there's more questions. Again, I mentioned this before, I've mentioned it throughout, but it is worth saying and repeating and repeating and repeating. All of your statements are connected, right? Our income statement, the statement of retained earnings, not really a true statement in the sense of we're talking today, but your net profit rolls into your balance sheet, rolls into your statement of cash flow. Your statement of cash flow also rolls into your balance sheet. So again, your net income from your profit and loss becomes part of the equity on your balance sheet through retained earnings. Your balance sheet cash must match cash flow ending cash. Your profit and loss depreciation affects your balance sheet equipment values, and your cash flow statement shows the changes happening both in your business operations through net income, but it also shows the changes on your balance sheet. Bringing it to Craig, following the money through all 3 of Craig's statements, what happened in August? Craig earned that $37.40 in profit, but took $3,000 as an owner's draw. And what does this show in each statement? Well, the income statement says Craig's business made $3,740 profit this month. Sounds great. But our balance sheet tells us a little bit more. Our balance sheet might show that our new cash balance is $1,300 less than it was the prior month. It shows a new accounts receivable, growing accounts receivable. It shows an increase in equity. The cash flow statement explains why all of these cash changes, despite the profit increase, that he started with $37.40 in profit, but customers owe him money, and he spent money on inventory, and he received bills that he hasn't paid, and he paid himself, and he paid his loan, and that end result was that $1,300 decrease in cash. So that each of these statements tells part of the same story, that he had a profitable month, but cash decreased due to timing, owner's draws, and collections. So I think no questions on that small section there, Lena?
No questions.
Amazing.
Oh,
So we are
actually, we just got one.
cool.
If we have not run these reports in the past, should we backtrack and run them now? Just been muddling along, making sure there is enough money in the bank to pay bills. We use spreadsheets, not software or an accountant. Very small business and not enough income to pay a bookkeeper.
Understood. So if you use spreadsheets and you have access to these historically, a good advisor should be able to help you recreate some of these statements. I find looking at trends to be really helpful, the trajectory of your business. So, I would recommend going back and trying to pull together, these things on a monthly, at least annual basis to see what's been happening. If your business has been open for more than a year, um, that's the only way you can do these analyses is by looking at these in a temporal sort of a sense. It could be challenging to pull these statements together. Um, the at the very least, your income statement, start there and compare that to, you can also, like if I were to do the bare minimum here, I would take my income statement and then I would also be tracking my bank account balance. Uh, that gives us a lot of the crucial pieces here. And I want to emphasize it's more important that you get into that habit of looking and reflecting, even if it's a smaller part of what we talked about today. Um, than getting all of this perfect. This is a big overview, a somewhat mature small business. So take what's useful, incorporate patterns. Don't kill yourself trying to get perfect financial statements tomorrow.
And there are other softwares that are cheaper than QuickBooks as well. If your business is not too complex yet, there are options there for you, and they can pull these statements for you more automatically.
Absolutely. And it can be a challenge to go on to most of these platforms allow you to upload transactions. So if you are in the place where you're not ready to use an accounting software, a great thing you could do that will make your life so much easier in the future when you are ready is to save down your bank statement data now when you can still access it in CSV Excel form, because most banks only maintain those records for a certain amount of time, and then you can only get paper statements, which can make it a lot harder to import historical financials. So save what you have, at the least save your statements, but yeah, talk about some free platforms. Is there another question, Lena?
Yes, just one came in. Can you give examples of the accounting software ugh, aside of QuickBooks?
Yeah. So I was just at the ASBDC conference, and Zero is gaining a lot of traction in the accounting in the small business world. I need to dig into that deeper. But one I frequently see people use is Wave, and it's waveapp.com. Wave app has a free version. Its free version has limited features, like it doesn't connect directly to your bank accounts, but I've seen some people use it really well when you've got kind of basic business operations, you don't have employees, you're not really dealing heavily with invoices. Some of those, again, are their paid features. So Wave app, their free version, can be a really good tool for a lot of business owners. FreshBooks is another one. Recently, I had someone ask me about Quicken, which is really cheap, but I cannot vouch for how well that works for small businesses. So there's a few. Okay.
Um, I think it might be okay to run over a few minutes. Don't worry,
This
Kara.
is beautiful. So putting it all together, what you can do is to how do you get into your monthly financial checkup? So this would be a great thing to aim towards, starting a little bit at a time. What a monthly review process could look like for you. Step one is generating your reports. So if you're using QuickBooks, logging into QuickBooks. If you're using spreadsheets, checking through your spreadsheets, bringing them together. Um, this is pulling down whatever statements you have available. So ideally your income statement, balance sheet, statement of cash flow. Make sure you're looking at the right date range, review it. If you don't normally look at these, like start looking at them today, and then do a little bit of a data quality check. Does your cash balance match your bank account? Do your sales numbers look right based off of your activity? Are there any obvious errors or round numbers that look estimated? As the business owner, you should be able to give a scan of these statements and be like, this number looks funny, I need to dig into it. So start getting used to doing that little bit of investigation. It could be something as simple as a miscategorization, and we want to keep some good hygiene while we can. Then we can do some quick health checks. So, we can look at the debt to equity ratio on our balance sheet. We can look at those cash flow patterns. We can see if those trends are moving in the right direction. And then, kind of taking it that zoom out view, looking at it, what were prior months? How are things going? And then step 4, the most important part is apply some tools and take action. If you see that your profits are plummeting, what are you going to do? Come up with a plan, at least one specific action to correct that next month. Maybe things are looking good, but they could look better. Come up with one specific thing that would help you improve your business for next month. This is just about getting into that habit of pause, review, reflect, plan. So what does this look like for Craig after 6 months after this training? Again, Craig is not real, but let's pretend this is you in 6 months. So 6 months from now, he's actually looking at his monthly reports, like his accountant has been asking him to do. He's been able to catch discrepancies, and he's been able to get his bank balance to match all on his own without, hand-holding from his bookkeeper. He uses the trend charts to spot the problems early. He's even applied the expense control rule during a slow winter and remained profitable while his revenue dropped. And he confidently discussed that debt to equity ratio when he was applying for new equipment financing. And he goes day-to-day managing the tight cash position proactively rather than reactively. His monthly routine includes monthly financial checkups. He always starts by checking if his numbers make sense. He uses the visual tools to make quick decisions. He asks questions when talking to his bookkeeper, and he monitors that cash flow and closely given the needs of his business. So again, here's our fake testimonial from our fake business owner. But I hope with this can be inspiration that I don't want you to be scared of your financial reports. I want you to think about them as tools. And that can be really helpful, especially when cash gets tight. So an action plan this week, find what you have. You may have to ask a bookkeeper or an accountant, do some quick checks, try to calculate some things based on some of the techniques we went through today. In the next 30 days, set up a plan to look at these reports monthly. Let's try to make some calculations, apply some of these rules, and then next quarter, try to address any data quality issues, systems issues, maybe try a new accounting system if you don't have one yet. We want to track these systems over time, and hopefully you get to a place by next quarter where you can use your financial analysis to make a business decision, potentially assess your funding readiness. We've got some resources on this slide that'll be sent out. A link here to that sample financial statement. It'll be sent separately. And we've got some recorded webinars, a link to the recorded webinars from the past, and links to some great upcoming webinars this month and next. And now we are only 4 minutes over time. So thank you for those who have been able to stay with me.
Thank you. We got one more question. What is the most common bookkeeping relationship? Monthly, quarterly, annually? Will bookkeepers provide you with an accounting software?
But most typically, and so first I'm going to start with the back. An ideal situation, your bookkeeper should be doing at least monthly, closing your books monthly. That is ideal. A great bookkeeper will be categorizing and working with you weekly. Those are rare, and those bookkeepers are expensive. So monthly is kind of the nice place to be. Some bookkeepers for businesses without a lot of activity do quarterly. So they'll close your books quarterly. I don't love that. I would prefer to be able to see that monthly check-in. If a bookkeeper is only working with you annually, then you are driving blind for most of the year, and it's too late to use your data to make any decisions. So using annually, that's basically just a bookkeeper so you're able to file your taxes. It's not using a bookkeeper to understand your business finances and use it for decision making. Second, some bookkeepers will use their own software and include that in their pricing. However, I do not recommend this. I recommend that you are the primary account holder for any accounting software that you use. And that's because, say, it doesn't work out with your bookkeeper. You need to find a new one. You want to own that data. You don't want them to own that data. So, if you're looking at finding a bookkeeper, you want to ask them preferences on their software. Um, there are bookkeepers that are kind of go along with any package. So for example, Wave app, which we mentioned, is low cost. Through the website, you can find Wave bookkeepers specifically. So there's a lot of places to find bookkeepers, and now a lot of bookkeepers work remote. I'll say I typically expect a bookkeeper monthly cost to be about $500. As another point, a really good bookkeeper, they might charge up to $2,000. Depends on your business. It depends on your needs. Some businesses are just much more complex and they need a lot more accounting support. So, you can find a discount bookkeeper for $200 or less, but keep in mind, there can be issues. And if you're paying a cheaper bookkeeper, you need to be involved and looking over their shoulder and comfortable checking their work.
Mhm. Thank you, Kara. I am a bookkeeper and send out statements every month. If they don't elect to talk about the statements, what can I send them with the statements each month so they'll understand them more?
Yeah, cool. So I think if you're sending them out as PDFs, you're basically just exporting them from QuickBooks. It might be an opportunity for you to also upsell your services because bookkeeping really is just categorizing, closing the books. Fractional CFO support is more consultative, where you're talking about trends, you're analyzing what you see. And so you could be going into QuickBooks, you could be pulling those statements, you could be importing them into Excel, adding notes, comments, highlighting questions, sending to them, and maybe offering them the opportunity to schedule, for a reasonable fee. I don't know, there's ways to think about it. For additional time, a 30-minute meeting to review those statements together, that's an option. But again, we want to encourage them. This is their business. They should want to understand the statement. And what are they paying you for? Are they paying you for your expertise? If so, maybe you're more of a fractional CFO than you are a bookkeeper. And you should charge accordingly.
Thank you, Kara. Someone said this was super helpful, not a numbers person, but I could follow this and learned a lot. Do we get a certificate of completion? I need it for SEAP program training hours. Good question. I am not sure that we can do that, but I will ask and see what we can do for you. Maybe just show proof that you attended or something like that. We'll look into it.
All right.
Feel
All
free
wrapped
to
up.
reach out. Sorry, feel free to reach out to my email that I sent around to request this and so that I can flag it and I can get back to you. I will resend it right now. All right. Any more questions? I will give 30 seconds more for anyone else to ask a question. Or maybe less than 30 seconds. Oh, not a question. Fantastic training. Looking forward to rewatching. And yes, I was just going to say that um, you will be getting your recording. Feel free to watch it, take breaks. This is very heavy stuff. It's not really always super easy to follow without breaks. So feel free to just rewatch as many times and then it will start clicking more and more as you rewatch. And I wanted to just thank Kara so much for such a fantastic training. As always, she will be doing this training again, as well as other trainings. We have QuickBooks trainings, we have financial basics trainings, and this training will be offered again in, I think, 2 months from now. So hoping some of you can join us again. And I would like to thank you all for joining and have a great rest of your days.
And if you fill out feedback, Lena, I would love to hear constructive feedback from the group. Things like slow down, things like this was confusing. I'll use it in the next training. So be brutal.
Thank you. Thank you. All right. Have a great rest of your day.